Okay, let's unpack this. We're diving headfirst into something pretty striking that's happening right now. Gold prices. They're not just up, they're hitting historic, like unprecedented highs in 2025. And this doesn't feel like just another market rally. It seems like it's pointing to something much deeper. Complex global shifts. We're talking geopolitics, big questions around monetary policy, fundamental economic changes, all kind of swirling together. It's fascinating.
It really is. And that's exactly what we want to explore for you today. It's not just that gold is up, it's the why. Understanding these underlying currents, well, that's essential to grasp the big shifts happening in the world economy. We're aiming to cut through some of the noise, look at what these forces mean for investors, for global stability, basically help you understand this fundamental reevaluation that seems to be underway.
Right, so where does this story really start to get interesting? I think it's the modern geopolitical landscape. That seems like a huge piece of this puzzle. Looking at 2025, things feel tense globally. Our sources are painting a pretty vivid picture, like China's big military parade back in September. That wasn't just ceremonial, was it? It felt like a very clear signal of, well, assertiveness,
Oh,
ambition.
definitely more than just pomp and circumstance.
Yeah, and what really caught everyone's eye was who was there. Putin, Kim Jong-un. Seeing them together, it underscores this idea of maybe a shifting axis of power, raises serious security questions regionally and globally.
Uh-huh. It certainly fuels that narrative.
And this isn't happening in isolation, right? We still have the ongoing conflicts in the Middle East, the lingering instability from the Russia-Ukraine war. It all adds up to this tremor of uncertainty in the markets.
Absolutely. And what's fascinating is how these geopolitical frictions translate into, well, concrete economic effects. Think about supply chains. Global instability disrupts how goods move, how resources are accessed. That's basic. But it also pushes up what economists call risk premia.
Okay, risk premia.
Yeah.
Basically, investors want more return for taking on more risk.
Exactly. If the world feels riskier, you demand higher compensation for investing or lending, especially across borders. And that naturally pushes capital towards assets seen as safe havens. Gold's history here is undeniable, isn't it? It's been the go-to refuge so many times.
Yeah, the Great Depression, the 70s inflation, 2008.
Right. Through all those crises, it held up. And in 2025, these escalating geopolitical risks are doing something similar. Investors are looking for protection from currency swings, from worries about governments defaulting, from systemic shocks. And gold plays this role because, well, its supply is limited. It has this intrinsic appeal. And
And
crucial,
tied to any government's debt.
precisely, it's independent from government-issued IOUs. That independence is absolutely key when trust in sovereign entities might be wavering. It's tangible. It's not someone else's liability. That's a powerful draw in uncertain times.
That makes perfect sense. That independence feels really central right now.
Right.
Okay, so geopolitics is pillar one. Let's pivot to the second major driver you mentioned, challenges in monetary policy. Because another defining trend of 2025, it seems, is this sharp rise in real yields on government bonds. We're seeing it in the U.S., U.K., Germany, Japan. I saw the 30-year U.S. Treasury yield was getting close to 5%. That's territory we haven't seen in decades. So for listeners, maybe break down what rising real yields actually means and why is it such a big deal?
It's incredibly significant and definitely not just a temporary blip. So real yield is just the return you get on a bond after you account for inflation, what your money can actually buy. When real yields rise, it means the actual purchasing power you gain from holding, say, a long-term government bond is going up. But the flip side is it signals a much higher borrowing cost for governments
Right.
and for investors. It throws a wrench into decades of portfolio strategy. Sovereign bonds, especially U.S. Treasuries, were always seen as that super safe anchor. Low risk, stable. Now, with real yield climbing, that assumption is being seriously questioned. Is it really low risk? Will it even beat inflation? This forces a major repricing of risk everywhere.
And what's
And
behind that repricing? Just changing views on growth and inflation.
that's part of it, sure, expectations shift. But there are deeper worries, too. Concerns about fiscal sustainability, can governments actually afford their mounting debts? And then there's this other crucial piece, the credibility of the institutions themselves.
You mean like central banks?
Exactly. Central bank credibility seems to be under strain. Our sources mention increased political scrutiny, public pressure. Think about the tensions around the Federal Reserve's leadership, for example. Historically, the idea was that central banks operate independently, focused only on economic goals.
Right, free from political meddling.
Well, now market participants are genuinely weighing the possibility that policy might be influenced by short-term politics, populist demands maybe. And that perception, whether fully true or not, it really undermines their effectiveness. It makes their future actions harder to predict.
Which adds more uncertainty.
Huge uncertainty, and markets hate uncertainty. When you can't rely on the central bank signals, when their independence seems shaky, investors demand higher compensation, especially for lending long term. It fuels volatility because that bedrock predictability is, well, eroding. Trust in these key institutions is becoming a much more expensive commodity.
Wow. Trust as a commodity. That's
Yeah.
a powerful way to put it. So let's connect the dots. We have rising real yields making borrowing expensive, worries about government debt, and this erosion of institutional trust. How does that combination impact the broader economy? You said it makes saving and borrowing pricier. That must hit governments hard, especially those already running deficits.
Absolutely. It fundamentally reprices the social cost of debt. This isn't just numbers on a screen. When governments pay more interest, that's less money available for everything else. Public services, infrastructure, you name it.
Right.
Or they borrow even more. It makes managing existing debt much harder, let alone funding new initiatives.
And the private sector feels it too.
Definitely. A higher cost of capital makes it more expensive for businesses to invest, to expand, to innovate. It influences decisions across the board, often leading to slower growth, maybe fewer jobs, a general tightening. And feeding into all this, we're seeing this really interesting trend pick up steam: de-dollarization.
Ah, yes, I've seen that term. Countries moving away from the U.S. dollar.
Essentially, yes, it's
Yeah.
about diversifying reserves. Many central banks, especially in Asia and the Middle East, are actively buying more gold. Why? To reduce their reliance on the dollar, hedge against currency risks, especially given all the geopolitical stuff we talked about.
So it connects back to geopolitics and trust again.
Precisely. If you connect the dots, this isn't just about gold price. It signals a potential shift towards a more multipolar monetary system. Nations are hedging. And gold's appeal here is obvious. It's non-sovereign. It's outside the traditional banking system. It isn't tied to one country's credit rating or political decisions. It can't be printed into oblivion. That makes it very attractive when you're worried about currency debasement or geopolitical fallout. It's an asset outside the direct control of any single nation state.
That really clarifies things. It's a move towards assets with no counterparty risk, essentially. So bringing it all together, gold's role in 2025 isn't just about being shiny. It's acting as strategic portfolio insurance, not just an inflation hedge anymore, but insurance against policy mistakes,
Yep.
geopolitical shocks. But why gold specifically? What makes it unique for this job compared to other commodities or even other safe havens?
That's the key question. Its uniqueness lies in that non-sovereign quality we just discussed. Unlike fiat currencies, which are basically government IOUs, or sovereign bonds, which depend entirely on that government's ability and willingness to pay, gold doesn't rely on anyone's creditworthiness.
It stands alone.
Exactly. When trust in those traditional pillars wavers, gold acts as an independent store of value. Other commodities like oil or copper have their uses, but they're tied to industrial demand, economic cycles. They don't have that same deep historical, psychological role as an ultimate safe haven. Even other safe currencies or bonds can get caught up in the very political or monetary issues investors are trying to avoid. Gold transcends that.
So it's less about chasing returns, more about stability when things get rocky.
That's a great way to put it. Its role, especially now, is much more about being portfolio insurance than a speculative bet on price increases. It's the anchor in the storm, not necessarily the fastest ship in the fleet. And just for educational context, this is an investment advice. Of course, practical things matter too, like liquidity.
Being able to buy or sell it easily.
Right. And secure custody, knowing your physical gold, if you hold it that way, is safe and accessible. And also thinking carefully about how much to allocate. Allocation sizing needs discipline, especially when even traditional safe assets like bonds are behaving, well, unusually. It's about a strategic approach, understanding gold is there to preserve wealth during periods of high global uncertainty.
Okay, wow. This has been incredibly insightful, tying all these threads together. So, to quickly recap, the historic gold prices in 2025 aren't just market noise. It's this powerful mix of geopolitics heating up, serious questions about monetary policy and central bank credibility, and these sharply rising real borrowing costs. It all points towards a kind of global reset in how we think about risk and finance. It's a lot.
It is a lot, but understanding it is crucial. Gold's resurgence isn't just a price story. It truly reflects these deep shifts in investor confidence, a fundamental reevaluation of risk, trust, stability, all the things we thought were settled in our economic frameworks. Seeing these drivers clearly gives you critical insight into the bigger picture shaping global finance right now, and potentially where things are heading.
It certainly does. And maybe that's the thought we leave you with today. How might this global rethink of risk and trust keep reshaping investment strategies? What does a safe asset even mean anymore? Will the old standbys regain their shine? Or are we entering an era where the search for truly non-sovereign independent assets leads us down entirely new paths? What's the next frontier for protecting wealth in this landscape? Definitely something to think about.